All right, welcome to The Explainer. Today, we are diving deep into the hidden psychology of building wealth. And you might be surprised to hear that your financial destiny has a lot less to do with what's in your bank account and way more to do with what's going on in your head. Let's get into it. So, let me ask you something right off the bat. Have you ever had that nagging feeling that your own emotions about money, I'm talking about your fears, your gut feelings, those little impulses, are secretly holding you back from where you want to be financially?
And look, this isn't just some philosophical thought experiment. According to a pretty detailed analysis from Morgan Stanley, the gap between what a simple, boring portfolio returned over 30 years and what the average investor actually took home, well, it could be a whopping $840,000. That is a life-changing amount of money.
And this chart, wow, it shows you exactly where that money went up in smoke. A simple, hands-off portfolio would have netted you almost 9% a year. But the average person out there making decisions based on headlines and gut feelings only got about half of that. That gap isn't a math problem, it's a human problem. That, right there, is the price you pay for emotion.
So what in the world is causing this, right? This massive gap? It's usually not about picking the wrong stocks or missing out on some super secret, complex strategy. Nope, it's all about our own psychology. It's about the mental traps we're literally hardwired to fall into. This actually brings us to this really fascinating field called behavioral finance. And what it does is it kind of throws out that old school idea that we're all perfectly rational robots when it comes to money. Instead, it shows us exactly how our mental errors and emotional biases cause us to make the same irrational mistakes over and over again.
Now the thing is, these mistakes we make, they aren't random. They usually come from one of two core mindsets that pretty much dictate our entire financial lives. Let's break these down.
So on one side, you've got the scarcity mindset. This is that little voice in your head that sees roadblocks everywhere, that chases the quick win and is obsessed with hoarding whatever it has. But then, on the other side, you have the abundance mindset. This way of thinking looks at the exact same situation and sees opportunities, focuses on the long game, and is all about growth and working together.
And this quote from Money with Katie, it just hits the nail on the head. You know the type, right? There's the friend who Venmo requests you for $5.12. The whole vibe is urgent, kinda untrusting. And then you have another friend who insists on buying you coffee just because. They're not keeping a running tally. So which of those two people do you think is attracting more opportunity into their life?
Yeah, that second friend, that generous, open energy, that is the absolute core of an abundance mindset. It's this foundational trust that there's enough to go around and that you have the ability to get what you need. And that belief encourages smart risks, it encourages collaboration, and it puts the focus squarely on growth instead of fear.
Okay, so where does this scarcity thinking even come from? Well, a lot of it is fueled by these, let's call them psychological bugs, these cognitive biases that are basically hardwired into our brains. These are the specific mental shortcuts that lead to those huge, costly mistakes we saw in that performance gap.
I mean, there are literally dozens of these, but when it comes to investing, there are three big ones you really got to watch out for. Loss aversion, which is our tendency to fear losing way more than we enjoy winning. Overconfidence, which, well, it tricks us into thinking we're smarter than we are. And the herd mentality, which is our powerful instinct to just follow the crowd.
Let's kick things off with herd mentality. We all know this one. It's that deep down urge to do what everyone else is doing, even if our logical brain is screaming that it's a terrible idea. It's all driven by that intense feeling of FOMO, the fear of missing out. And man, can it create some absolutely massive market bubbles.
I mean, you want a perfect example? Look no further than the dot-com bubble in the late 90s. After a few big IPOs like Netscape, everybody and their brother started piling into these internet stocks, even the ones with no real business plan. It was pure hype. And when that bubble finally burst in 2000, that same herd instinct flipped, and a wave of panic selling just wiped people out.
So what is it that drives that kind of mass panic selling? A lot of the time, it's this other super powerful bias, loss aversion. Get this, scientists have found that the sting of losing $100 feels about twice as bad as the joy of gaining $100. That intense fear of loss is what causes us to sell at the absolute worst possible moment, right at the bottom of a crash, and lock in those losses for good.
Okay, so if those are the bugs in our mental software, what are the features? How do we actively build a mindset that actually grows our wealth instead of, well, blowing it up?
It really boils down to developing a few core habits. Think of it as a sequence, moving from simple patience all the way to building systems for success.
And it all kicks off with the big one: mastering delayed gratification.
You've probably heard of the famous Stanford marshmallow experiment, right? This is that exact principle in action. And you know what? It's also the engine behind compound growth in investing. Making a small sacrifice today, like putting money into your retirement account instead of buying the newest phone, is what creates those massive returns down the road. It's basically about training the logical part of your brain to tell the impulsive part to just wait a second. Next up, and this is so critical, is embracing a growth mindset. This is the belief that you're not just bad with money. Your financial skills can be learned and improved with effort. It's about seeing a financial setback not as "I'm a failure," but as, okay, what can I learn from this? It's no accident that guys like Warren Buffett are famous for reading for hours and hours every single day. They treat learning as the best investment they can possibly make.
So, when you start consciously putting these habits together, delaying gratification, always learning, and taking ownership, you make a huge shift. You go from being a passenger, reacting to the market's every whim, to being the pilot, proactively designing your own financial future.
In this model right here, it shows you how all these pieces beautifully click into place. See, the target isn't just a big number in an account. It's about using smart investment strategies to reach true financial independence. Because that independence, that's not even the end goal. It's the foundation that gives you the freedom to chase what actually matters to you.
Because at the end of the day, this isn't just about stacking up cash in an account, right? It's about achieving what's called financial well-being. That's the state where you can pay your bills without stress, you feel secure about what's coming next, and this is the big one. You have the freedom to make choices that let you truly enjoy your life on your own terms.
So here's the bottom line, the big takeaway from all of this. Your wealth isn't just built on Wall Street, it's built between your ears. That gap between a scarcity mindset and an abundance mindset can literally be worth hundreds of thousands, if not millions of dollars over a lifetime. So I'll leave you with this question. What's the one small mental shift you can make starting today to begin that journey?